It's a truly honor to introduce Mr. Howard Marks today, who is the co-chairman and co-founder of Oak Tree Capital. Howard does not need an introduction. I just saw he's like a rock star in the morning in the breakfast room. But I would share a few personal anecdotes with you. So I first met Howard about 10 years ago, actually at a breakfast room at St. Regis in Beijing. And ever since then, I've been trying to follow his works. And for those of you who know him, that has not been an easy task because he's a very prolific writer. He has had 113 investment memos and counting, and 2 books. One is the most important things illuminated, and the new book is Mastering the Market Cycles, Getting the Odds on Your Side. So I have learned so much from Howard and from reading his memos and books. There's no question that Howard is among one of the greatest investors of our time. But to me, he's not just an investor, he's also a philosopher. I have had the fortune to had so many conversations with him in the past 10 years or so. I learned so much from him, not just about investing, also about life. So in a recent conversation Howard and I had, we were discussing about learning. And I was sharing with him that the more I learn a subject, the more I feel like I don't know. The more I know about something, the more I feel like I don't know, and the more I want to know. So in that context, Howard shared his wisdom with me and with a voice memo. So please let me play the voice memo for you.
This is a quote from my mother, who used to say, "He who knows not and knows not he knows not is a fool, shun him. He who knows not but knows he knows not is hungry, teach him. He who knows but knows not that he knows is sleeping, wake him. He who knows and knows he knows is wise, follow him."
So I can go on for an hour about the things I have learned from Howard in the past 10 years, but that's not the point today. And it's much better to hear that directly from Howard, particularly on market cycles and how to be a long-term investor. So without further ado, please welcome Mr. Howard Marks.
Thank you very much, Ben. And thank you all for having me in today. My history with CalPERS goes back a long time, and it's great to continue it and renew it with you in connection with Ben's arrival. First, I want to congratulate you on attracting Ben. He's going to be a great asset to CalPERS. He is as you could tell from his presentation this morning, he's a deep thinker on investing, and investing is a deep subject. You can hire a CIO who will come in here and say, well, our job is to figure out which things are going to go up and buy them. And that is a vast oversimplification. Ours is not an area where the harder you work, the better you do. You have to develop a deep understanding. As a friend of mine in England wrote a book, it's entitled Simple But Not Easy. And I think that's a pretty good job description for all of us. I'm very glad to be able to participate with you in that vein today. So as Ben mentioned, my second book came out in October, and the title is Mastering the Market Cycle, Getting the Odds on Your Side. And I'm going to tell you a little bit about that book and its ideas right now, and then I'm going to follow up with the discussion, as Ben asked, about the ramifications of trying to put these thoughts into operation in a large institutional setting. I'm sorry for the small print. Ben's was much larger. What is a cycle? It's a pattern of up and down oscillation over time around a midpoint. Why are there cycles? This is really an interesting question. When I was writing the book, and as I got close to the end, I'm a great believer in cycles. I've been in this business 50 years. I've lived through half a dozen major cycles. I accept that they exist. I think I know why. We'll always have them. And yet, as I reached the end of writing the book, I asked myself the question, why do we have cycles? If the U.S. economy, for example, grows at about 2% a year on average, why doesn't it just grow 2% every year? Why sometimes more and sometimes less and sometimes goes down? And if the S&P 500 averages about 10% a year on average, why doesn't it just return 10% a year? Why sometimes 25 and sometimes negative? And in fact, if you look at the history, even though it averages 10, it rarely returns between 8 and 12. So why is the average so far from the norm? And the answer, in my opinion, is simple but important. Most positive trends eventually are carried to excess, and those excesses eventually correct on their own or are corrected. So rather than ups and downs, I thought it might be helpful to think in terms of excesses and corrections, the role of people in the market. I was talking to Bill about this just this morning, but it's the involvement of people that makes the markets so challenging. The physicist Richard Feynman said that physics would be much harder if electrons had feelings. You walk in the door, you flip the switch, the lights go on every time. The electrons flow that way toward the light from the switch. They never flow that way. They never go on strike. They never get tired. They never forget to flow. They always do what they're supposed to do. And so we can depend on the light to light. But when you get people involved, and that's all that economies and markets and companies are, is people. People have feelings, and people feel differently about different tasks at different times and feel differently about information and how they're going to incorporate it at different times. And so we have excesses and we have corrections. For example, the management of a company feels good about business in the coming years. They believe they're going to have an uptick in sales. And so they say, well, let's build a new plant, let's hire some more workers, and let's produce so that we can increase our inventory so that when the increase in sales come, we'll be ready. Now, the issue is that usually several companies decide to do that at the same time. Several plants are built. Several companies add to inventory. And that period of growth is a period that's above average in terms of GDP. That's how you get above average results, kind of like we had last year. But eventually, sometimes things slow down, and it turns out perhaps that the sales that everybody built their new factories for don't materialize. Now they close the plants and they produce they sell from inventory rather than producing more, and that's a period of correction. That's a period of below average growth. So excess and correction. Similarly, in the investment markets, we know that the company's earnings will grow at a basic rate over time. But sometimes investor psychology turns very positive and causes excitement, causes investment prices to go up faster than the rate of growth in earnings, or what Ben called fundamentals. The period of above average increase in price relative to the fundamentals, that's a period of excess. Eventually, if it goes on long enough, the excess gets so great that it has to be corrected, and that's how you get a period of below average growth. So this is what happens. Excesses and corrections stemming largely from swings in psychology. Now, are cycles dependable? The key is understanding that what Mark Twain, the author, is supposed to have said, history does not repeat itself, but it does rhyme. So cycles are not the same. The details of cycles vary. Their amplitude of the fluctuation, the speed of the fluctuation, the power of the movement, the duration of the cycle, it varies from one to the next. These things cannot be depended on. And you cannot invest under the assumption that they'll be the same. So do the causes of cycles and the effects of cycles. So you cannot put this process on autopilot. And this is one of the big reasons for the importance of luck that Ben described. But certain underlying themes do recur, or as Mark Twain would say, they rhyme. And recognizing that pattern over time can be very helpful to the investment process. It can't tell you what's going to happen in the future, but it can help you deal with your environment. And in the bull market cycles that I've seen in my 50 years, 3 elements have rhymed, have recurred. They have been present in bull markets almost without exception. Too much optimism, too little risk aversion, too much capital availability. If you look at those 3 elements, number 1, they're a pretty good recipe for a bull market. And number 2, it's hard to imagine having a bull market in their absence. So I would say that this is a theme that rhymes. Too much optimism. What does that mean? Well, 2 things determine security prices, broadly speaking. Reality, that is the fundamentals, the earnings, the asset values, the excellence of the company's management, and perception, which is basically how people feel about the reality, filtering it through their emotions and their biases and their psychology. So fundamentals times perception equals price. Clearly, fundamentals don't change that much. A company's earnings don't change that much from quarter to quarter. Certainly, the long-term outlook for a company's earnings don't change much from a quarter to quarter. But yet, psychology changes volatilely and dramatically, as we've seen in the last 4 months. And so the swings are great. When people feel very good about assets, they apply a high valuation to the fundamentals. The upswing is the kind of excess we all like to live through. That's how you get a bull market, but it leaves the market vulnerable to the downward correction. So the amount of optimism which investors are applying to the fundamentals at any given point in time is a real determinant of A, whether we have a bull market, but B, whether the market is susceptible to a decline. Then there's the question of risk aversion. This graphic suggests, with return on the vertical axis and risk on the horizontal axis, that there is a positive connection between risk and return. Now, most people take this to mean 2 things. Number 1, that riskier assets produce higher returns. And number 2, that if you want to make more money, the way to do it is to take more risk. This can't be right. These are terrible formulations for the simple reason that if risky assets could be counted on to produce higher returns, they wouldn't be risky. So that can't be right. What this relationship means is that assets that appear to be riskier have to appear to offer higher returns. They don't have to deliver them. Again, the uncertainty or risk that Ben alluded to. But when investors are objective and rational and sober, they demand higher returns, higher expected returns from riskier assets, and that keeps the market safe and sane. That means that they apply careful due diligence, they use conservative assumptions, they do not give the benefit of the doubt to positive outcomes, they demand high returns from risky assets, and that makes the market safe and sane. But sometimes people get too optimistic about the future. They forget to do these things. They allow risky assets to exist without the prospect for high returns. That is to say, the risk aversion, which is natural in people, sometimes is suppressed because of an excess of positive psychology. When this is the case, the return for taking risk is less than it should be. Risk-taking should be avoided. The third thing is the impact of capital availability. As a result of the due diligence process that I just described, investors should be making a reasonable amount of capital available for investments that offer a good ratio of return to risk. That's our function. But sometimes the suppliers of capital have too much money on their hands, and they become too eager to put it to work, and as a consequence, the auction goes too high, prices are excessive, returns are high, and prospective returns are low, and risks are high. And this is one of the most dangerous conditions. My last memo was entitled "The 7 Worst Words in the World." And what are they? Too much money chasing too few deals. And when we have that, and we add it to a paucity of risk aversion and an excess of optimism, that's a good formula for bull markets. So we should know when that's the case, and we should take action. So the key to understanding the riskiness, the key to understanding where those return distributions that Ben showed you stand, is to understand where the market is in its cycle. And so I'm going to take you through the way that cycles work. Now, we're coming out of a crash. We're coming off a low. We're coming out of a period in which everybody's been disappointed and loses money, and most people are feeling quite bad, and as a result, asset prices are low. And we get into an upward period. And on the upswing, economic fundamentals are improving, and company earnings are increasing and beating expectations, and the media are reporting only good news. Usually the media do one or the other, and right now they're in a positive phase. As a result of these things, investor expectations rise, investor psychology strengthens, people perceive only favorable developments, capital is readily available, asset prices rise, asset holders are happy and want to buy more, people who haven't been holding throw in the towel and begin to buy. All of these things drive prices up, causing risk aversion to evaporate, causing people to embrace risk. And what do they say? Risk is my friend. The more risk I take, the more money I make. And that's how you get a bull market. And eventually something is reached called a top. That's the day that prices get as high as they're going to get. Asset prices are high, prospective returns are low, and risk is high. This is the time for caution. I think it's obvious from this description that this is the time for caution. And yet, most people are euphoric, since the top in prices, by definition, coincides with peak psychology. No one is willing to bear the risk of missing out on further gains. They get too excited when prices are too high, and that's how you get into trouble. Things don't remain good forever. Eventually, things turn down. Economic fundamentals deteriorate, earnings decline and fall short of expectations. The media report now only bad news. And as a result, expectations decline, investor psychology weakens, people see only undesirable developments, asset prices fall. This causes asset holders to be chagrined and to sell, and it causes non-holders to celebrate their wisdom and stand pat, refusing to buy. So risk aversion grows. Investors now flee from risk, saying, bearing risk is just another way to lose money. I don't care if I ever make a penny anymore, get me out. And of course, this is the short-term thinking that Ben says is so important to avoid. So we reach a bottom, and now asset prices are low, prospective returns are high, and risk is low. This is the time to be aggressive, but most people are scared stiff. No one wants to commit capital under these conditions, since prices reach the bottom just when people are the most depressed and cautious. So you can see that the return on investments and the risk on investments is largely determined by where we stand in the cycle. The cycle takes things to excess. We must not. It's really as simple as that. Now, to go along with, second, what Ben said about uncertainty and randomness. In the book, I say at length that I feel that the market is like a lottery. There's your randomness. Investment performance is one lottery ticket drawn from a bowl that holds lots of tickets. The one ticket which is drawn is the outcome. The many tickets in the bowl are the many possible outcomes, but only one will be drawn. Now, the assets in the bowls that are priced below their intrinsic value, those are the potential big winners. The assets that are priced above their intrinsic value, those are the likely losers. And there are some of each in the bowl all the time. That's why this isn't a precise process. Which ticket is chosen from the bowl? Too close. Thank you. Which ticket is chosen from the bowl? Which outcome occurs of the many that could occur is influenced by the merits, that's the skill, but also to a large extent by swings in emotion and by random events. We never know enough about the future to be sure what the outcome will be. That is to say, we never know which ticket will be drawn from the bowl. But we can have a sense for when the tickets in the bowl tilt the odds in our favor and when they're against us. And Ben and I both use getting the odds on your side as the title for our message. Now, what determines the mix of tickets in the bowl and what determines the odds of investment success over a given period? In large part, the position of the market in its cycle. And this gives you an idea how the market moves over time. Prices fluctuate from cheap to fair to rich and back again. Sometimes they reach extreme highs and sometimes they don't. We can make judgments when the cycle is at extreme highs and extreme lows where the logic is compelling and the probability of success is high. Never total, but high. In between, when the market is fluctuating around the intrinsic value within the range of fair, we can't say much that's very brilliant, and we shouldn't try to. The important thing is, as I show at the end, from any given point, it's possible for security prices to go up or flat or down. The fact that something is overpriced doesn't mean it's going to go down tomorrow. The fact that something is underpriced doesn't mean it's going to go up. Even something that's overpriced can become more overpriced. Less underpriced can get still cheaper. So nobody should expect that they understand what's going to happen in the short run, but we should understand the odds. And where we are in the cycle determines the odds and thus can help us to determine what the wise action consists of. So that's cycles and how they work and how I hope you'll think about them. And the other thing Ben asked me to talk about is how these ideas can be implemented in an investing institution. This is about how I would organize and operate an investment department. I was asked to formulate this presentation by a state treasurer of one of our clients, and I've pulled out the slides that I hope will be most relevant to you. First of all, you have to start from reasonable expectations. If you have unreasonable expectations, you cannot have a successful effort. One of the things you should understand in investing is that it's extremely easy to be average, and it's extremely hard to be above average. This is not an area where you will, as I said before, increase your results just by trying harder. So the choice between average and above average is very important. You have to decide up front whether you will strive to be above average, which costs money to try and is far from sure to work, or whether you will accept average performance, you avoid the cost of trying, and you avoid the risk of being below average, but you have to look on as other people have great winnings from time to time. A decision to strive for a superior result should be based on conviction that A, assets are often mispriced, and B, your organization is capable of finding the mispricings. It's as simple as that. Number two, make your goals explicit. Every coherent investment program has to have an explicit goal, and you are blessed with a goal. You have an actuarial assumption which defines what you have to try to do. Now, it's expressed in absolute terms, and so sometimes the market will outperform. Your 7% won't look like great success. Sometimes the market will underperform. Your 7% will look great. Will you avoid talking too much about your relative performance and keep the focus on the absolute return? The other thing is that the time frame has to be explicit. The goal doesn't have to be achieved every year. Nobody can make 7% every year. The only thing that matters is achieving it on average over the long term. And full market cycles, Ben said 5 years. Sometimes you complete a market cycle in 5 years and sometimes you don't. Full market cycles present a reasonable time frame for the purpose of assessment to figure out whether a good job was done and to abstract from the influence of luck. You have to make sure that your goals are realistic and achievable. They should reflect and accommodate to the investment environment. In recent years, the risk-free rate has been 2. Treasuries have paid 1 or 2 or 3, and the consensus thought that stocks would do about 5 or 6. This has been a very tough time to get 7 or 8, as Ben described, and you've been smart to pull down your assumption to 7. But the question is, will it be achievable in the coming years? Ben says not easy, and I have to agree. Your expectations should reflect the realities of your situation. You have to think about your expectations in these ways. Are you small enough to benefit from selectivity, contrarianism, active management, as Ben said, nimble? Not easy for the largest pool of capital in America. Does your financial condition mandate conservatism or permit a more aggressive approach? You're underfunded. You have to reflect that in your activities. Does achieving superior returns, since it requires heightened risk-taking, should that be your goal? You can't get higher returns without taking more risk. Are you willing to do that? Will your institutional setting permit you to attract and retain people who are above average? You can't have above average results without above average people. This is a competitive game. Will your realities permit you to focus on the long term and ignore the short term? Probably the most important consideration. And given how hard it is to perform above average, do you have reason to think you can? You can't say we want 7 without answering these questions. And you can't say we hope to be above average without thinking about these questions. And Peter Bernstein, who was a great investment sage, said the market is not an accommodating machine. It will not go where you want it to just because you need it to. Very, very important. You need 7. That doesn't mean it's easily achieved. So you have to formulate, perhaps, an opinion regarding cycle positioning, the things we were just discussing. The goal in cycle positioning is to hold more of something when it's cheap and less when it's dear, and to increase your aggressiveness and defensiveness at appropriate times. It has to be based on the belief that opportunities to benefit exist and can be recognized and taken advantage of. The keys lie in the awareness of where the market stands, contrarianism, counter-cyclical behavior, and the pursuit of relative value. But it isn't easy, as I said. Today's valuations already reflect everybody else's efforts to do the above. Can you do a superior job? And if not, your efforts will be in vain at best and costly at worst. So how much will you try to get it right or defend against getting it wrong? You have to understand the essential nature of contrarianism. If you're going to try to vary your activities at points in time and buy more of this than most people own and less of that, and be more aggressive at some times and more defensive at others, you have to realize that the investing herd is usually wrong at the extremes. The herd becomes more optimistic, as I described, when things go well, and more depressed when things go poorly. They're more optimistic when prices are high and more depressed when prices are low. Thus, contrarianism, doing the opposite of the herd, is an essential element in superior investing. You have to be fearful when others are greedy, and greedy when others are fearful. But contrarianism is not easy. This is particularly true because most investors are subject to the same environmental and emotional influences as the herd. Remember, even the best contrarian decisions often fail to work immediately and thus look wrong for long periods of time. Can you live with that? Another factor is to decide how reliable you'll expect your process to be. Ben described the role of luck as opposed to skill. Skill helps you do the right things if you have it. Luck means that it's going to work some of the time and not others. John Kenneth Galbraith, one of my heroes, says there is nothing reliable to be learned about making money. If there were, study would be intense and everybody with a positive IQ would be rich. And I said in my memo, Dare to be Great, about investment behavior 13 years ago, not only am I unaware of any formula that alone will lead to above average investment performance, I'm convinced that such a formula cannot exist because the golf course changes on us. The things we did yesterday may not work tomorrow. Process alone will not suffice. An average process operated in an average way will lead to average results. Superior judgment is the essential ingredient in superior results. Now, seconding what Ben said before, most strongly, you must insist on a long-term focus, especially for an institution of your size with the important long-term needs and goals. You have to realize the realities about timing. It's hard for an investor to consistently do the right thing. It's impossible to consistently do the right thing at the right time. Impossible. No one and no organization can consistently achieve short-term goals. And anyway, only long-term performance matters. That's the mantra that you must drill in. Short-termism is one of the greatest weaknesses in investing today. Well, those are the facts as far as I'm concerned. And if you agree with them, you should de-emphasize the short run. Given that no one can be right consistently, penalizing short-term underperformance, which we agree doesn't matter, will discourage constructive long-term creativity. So, you know, if you say, well, you put that in last quarter and it didn't work, you're an idiot. That's not going to encourage long-term behavior. An easy way for an organization to distinguish itself, and by the way, this can be done even at scale like yours, is by focusing on the long run, not the short run, but you have to walk the walk. You can't just say we're long-term investors. You have to make clear to all involved that you only want long-term decisions. You have to de-emphasize reporting on short-term results. You can't spend every minute of every meeting on last quarter's performance and expect people to think that you care about the long run. And you have to base compensation on long-term performance, not short-term performance. These are essential ingredients. Now, the ultimate issue is to decide whether your organization will dare to be great. That was the title of a memo I wrote back in '06, which talked about how investment organizations should operate. And I updated it in 2014 to add 3 concepts. Because I said in 2014, of course, everybody dares to be great. That's not the question. The question is, Do you dare to behave unconventionally? Do you dare to bear the associated uncertainties? Will you accept the risk of being wrong? These things accompany the effort to be great. How will you define success, and what risks will you take to achieve it? And as I wrote in that first memo, how much emphasis should be put on diversifying, avoiding risk, and ensuring against below-pack performance, which many institutions spend a lot of time trying to do, and how much should be sacrificed in order to the hope of doing better? It's as simple as that. It's an active choice. Will you dare? 3 elements. Number 1, will you dare to be different? You look at this matrix, and what it says is you can behave conventionally or unconventionally, and you can run into favorable outcomes or unfavorable outcomes. If you behave conventionally and you get favorable outcomes, you will have average good results. If you behave conventionally and you run into bad outcomes, you'll have average bad results. If you behave unconventionally and run into bad outcomes, you'll have below average results. But if you behave unconventionally and run into good outcomes, you'll have above average results. Which of those 4 quadrants do you want to operate in? It's a fundamental decision that you have to give Ben your guidance, and you have to get behind what is agreed on. Buy-in is the key. Unconventional success cannot lie in doing the obvious. The investing herd pursues the obvious. Conventional behavior will, by definition, lead to conventional results. You cannot expect anything else. So as I wrote in that memo, only if your behavior is unconventional is your performance likely to be unconventional, but only if your judgments are superior is your performance likely to be above average. Or as David Swenson, who runs the endowment at Yale, which is the best performing university endowment, and he's run it now for, I think, 33 years, he says, this is really key, and if you get nothing else from this presentation, I hope you'll get this. Establishing and maintaining an unconventional investment profile requires acceptance of uncomfortably idiosyncratic portfolios, which frequently appear downright imprudent in the eyes of conventional wisdom. Uncomfortably idiosyncratic are 2 beautiful words. Idiosyncratic means you don't do what everybody else does, and by definition, it's uncomfortable. You're refusing to buy when they're buying at the top. You're refusing to sell when they're panicking out at the bottom. It's going to be uncomfortable. People are going to say, why are you doing different from everybody else? But if you can't do different from everybody else, you can't do better than everybody else. It's obvious. So the question is, will you dare to be different from others? Now, that leads to another question. Will you dare to be wrong? Every attempt at above average performance will expose you to the possibility of below average performance. Those 2 possibilities are inseparable. Most institutions invest a great deal of capital, effort, and opportunity to avoid the embarrassment that results from being wrong. That's the definition of an institution. My dad used to say, marriage is a wonderful institution for people who like to live in institutions. And we know what he meant by institution. So consider, for example, what I think is the ultimate conundrum, which I've seen in play over my 5 decades. For most bureaucracies, the unspoken rule is simple. We would never do so much of something that if it turned out to be a mistake, we would look bad. And for people who live in institutions, that might be an effective rule. But you must accept that it means you will never do enough of something so that if it turns out to be a good thing, you'll move the needle. Do you accept that, or do you refute that? Trying to do better than average means accepting the possibility of doing worse than average and the associated headline risk. And by the way, let's not kid ourselves, this is a political setting. And the Sacramento Bee is still very active. So can you, in order to try to do the thing in the long term, can you live with a headline that says CalPERS had a bad quarter? It's going to come down to that. In particular, think hard about the headline risk. So the next question is, will your environment encourage trying to be great? Bureaucracy and great investment results tend to be mutually exclusive. Dave Swenson, again from Yale, another great statement. Active management strategies demand uninstitutional behavior from institutions, creating a paradox that few can unwind. Will you unwind it? This is largely because unconventional behavior is inconsistent with bureaucratic oversight. By the way, nothing can be proved about the future. Investment judgments are about the future. Nobody can prove to you that they are correct a priori. Will you take the actions anyway? I say here that bureaucracies are unlikely to coalesce around idiosyncratic decisions. John Maynard Keynes said 90 years ago that worldly wisdom teaches us that it is better for reputation to fail conventionally than to succeed unconventionally. Will you try to succeed unconventionally at the risk of failing unconventionally? What will be your response? Will your organization be permitted and enabled to act unconventionally? Will you try to reduce bureaucracy, or will you give up on achieving great results? There is no third option. That's the choice. And finally, will you dare to look wrong? In investing, it's hard to do the right thing and impossible to do it at the right time. And that means that even correct actions may take a while to work, and in the meantime, they're going to look like mistakes. A good decision that hasn't worked yet looks like a mistake. The penalties that institutional investors face for being below average can exceed the potential rewards for being above average. Think about your own staff. They make an unconventional decision, turns out to be a great decision. Their upside is limited. But they make an unconventional decision that looks like a mistake. Maybe they're shown the door. So can you relieve them of the asymmetric incentives? Now, what I said in my latter memo in 14, unconventional behavior is the only road to superior investment results, but it isn't for everyone. In addition to superior skill, successful investing requires the ability to look wrong for a while and survive some mistakes. And part of what Ben is asking for is the ability to look wrong for a while and live through what appear to be mistakes in the expectation that they will turn out to be good decisions. And you should consider whether your organization's goals are consistent with the realities of the environment. Can you endure long enough for the wisdom of your correct actions to become apparent? It really comes down to that. So you can't try to be superior without running the risks of being inferior. Most loss minimization strategies eliminate the possibility of substantial gain. So you're left with a choice between these two balloons. On the left, you can try to be right. That is, you can try to be above average and act unconventionally, but you must run the risk of being wrong. The alternative is you can employ can't-lose strategies. Buying treasuries is a can't-lose strategy. Buying an index fund for stocks is a can't-lose strategy, but you can't win. If you invested in an index fund, you absolutely guarantee that you will not underperform, but you absolutely give up the possibility of overperforming. So you must choose one of those two balloons. What would most people say? Well, why don't you just try to be above average by using can't-lose strategies? That combination is not available. And that's what you have to interiorize it. So you can choose that balloon, or you can choose that balloon, or you can choose any point in the middle which mixes the two. And that's an important thing for every organization to know. How will you position your effort on that spectrum? So to wrap up, the final slide, you'll be glad to know, says never forget the inescapable truths. And this is everything I've learned in 50 years on one piece of paper. Investing is a challenging, messy, and imprecise activity that has to be engaged in on the basis of estimates, intuition, and subjective judgment, not accurate forecasts, scientific laws, and dependable processes. And that's the most important thing. Nothing is sure to work every time. The best you can hope for is that you will be right more often than you're wrong, and your successful decisions will add more than your mistakes subtract. Nothing will lead to superior results in the absence of superior implementation, but even superior investors are far from perfect. The environment does not remain static. The actions of the participants in the market alter the market. So important. The things that you must do for success change from time to time. The quest for gain causes easy answers to be driven out. Think of, it's appropriate for this part of the country, think of the gold rush. It was easy when only one guy knew there was gold. But when there were thousands, it gets harder to find a winning claim. Yesterday's right answer can be today's wrong answer. So you can't come up with a decision rule and stick with it. Importantly, everything that's important is counterintuitive, and everything that's obvious is wrong. At the top, they say it's obvious that stocks are going to the moon. At the bottom, they say it's obvious that the financial system is going to melt down. Everything that's obvious is wrong. Ego, emotion, and human nature are dangerous enemies to this investment process. On average, the average investor produces average results before fees and below average results after fees. Very few can consistently be above average, especially in the more efficient markets. So those are the realities in which your investment office, your chief investment officer work. And you have to accept those realities. You have to incorporate those in your process. You have to be understanding of the realities. And, Charlie Munger, Warren Buffett's partner, and I were having lunch one day just before my first book came out, and he gave me a quote that I rushed into the book because it's so important. He said, "It's not supposed to be easy. Anybody who thinks it's easy is stupid." And this is the truth. And so patience, understanding the nature of risk-taking, long-term horizon, not expecting perfection, and being supportive. These are all essential elements in institutional success. So I hope that helps, and I hope I accomplished what you hoped, Ben. And if there are questions, I'll be glad to take them. Dana?
Well, thank you, Mr. Marks, for that thought-provoking presentation. And you've given us a lot to think about, and we appreciate the effort you made to get here because we know there were some issues you had to deal with to get here to join us, so we really appreciate that. Mrs. Hollinger.
Oh, thank you. I really appreciate your remarks, and Ben, I'm also very supportive of you and look forward to working together. Mr. Marks, I represent the insurance industry chair, so my whole training is all about controlling your downside risk, and the insurance industry always manages to a liability that actuarially based. So when I got on this board, one of the challenges for me is to obviously get comfortable with the level of risk we have to do to achieve the same result, to secure those benefits. So what I really appreciate that you're doing and what I struggled with is I recognize that while we're pricing our guarantees at 2%, as you said, I recognize that it's also not our friend if we have low or flat returns. We can't afford that because for our stakeholders, our beneficiaries, that would be detrimental. So we have to do something.
Right.
And
Well, Dana, you know, investing is really only one thing. It's the acceptance of risk in the hope of profit. And I have always thought of my job as being completely analogous to the insurance industry. You know, what do people say? People say, I don't want the risk of driving my car without insurance. I want you to take the risk.
Right.
I'll pay you something called an insurance premium to take the risk I don't want to take. And that's what investing is. We take risk, we provide capital in the hope that it'll be profitable for us.
Right.
If you take no risk, you won't make any return. If you take stupid risks, you'll be run out of business.
Right.
You have to find something in between. And more than anything, I think it's the job for your CIO and your investment office to ascertain that the risks they're taking in the pursuit of your required return are prudent. And risk cannot be quantified. I believe that very strongly. You can't, risk is the probability of a bad outcome.
Right.
And you can't quantify it, you can only estimate it. And the people who, in the insurance industry, for example, I've always been in awe of the people who price catastrophe insurance. You know, I have a casino in the Bahamas, I want to buy a policy which protects me if there are 2 hurricanes this year. What's the right premium for that? Very hard to say, but it can only be set by people with good judgment.
Yeah, so thank you.
Yeah.
Thank you.
Yeah, thank you, Mr. Marks. I have a question. In your presentation, you talked about financial condition as one of the elements that needs to be considered. And so I would like to hear your thoughts about how do you factor in a low funded status in relationship to your risk appetite?
Well, that's very interesting because, you know, from 2000 to 2010, I was the head of the endowment at the University of Pennsylvania, my alma mater. And Pennsylvania was underfunded when I took over. It was 70th in the country in endowment per student. And it's a very interesting question. Would you say we're poor, so we have to absolutely hold on to what we have? Or would you say we're poor, so we have to invest aggressively to close the gap? Another of the questions which is not easy to answer, and I wrote a memo about that experience, which I'm sure Ben will be glad to give you if you like, or any of the memos that I've mentioned today. I think that you, especially, you know, if it's a corporate pension fund and they have a couple bad years and they blow a bunch of the capital, they're required to replace it. In the political environment, in a state where the government is not in excess funds, it'd be hard to replace it. So I personally think that you have to lean toward caution. And that, you know, I always say that when people come to me for financial advice, I say, well, which matters the most to you, making a lot of money or holding on to what you have? And of course, they always say both. But you can't honor both equally. And I think that you have to put more of an emphasis on avoiding losing money, which means putting somewhat less emphasis on making sure you don't miss any of the upside opportunities. That's your essential choice. But I think that given the underfunded status, what you have to do is you have to say, look, we're not going to get where we need to get without taking risk, but we want to take it wisely and in prudent proportions.
Okay. Ms. Yee?
Thank you. I wanted to just kind of go back to a note that you made about how there is a good deal of mispricing of assets and how some of the savvy investors are able to take advantage
I'm sorry,
of it.
I can't quite hear you.
Your statement about how there's a significant amount of mispricing of assets and how the more savvy investor can take advantage of that. are we not doing that enough? And I guess I'm just trying to figure out with a fund like ours where we do mostly passive investing with respect to our equities, how do we respond and put ourselves in a position of being able to take advantage of it?
Well, I had the advantage of going to the University of Chicago back 50-odd years ago for my master's degree, where the new theory of investing was just being taught. And it taught me something which is not a rule, but it's a foundation piece, which is called the efficient market hypothesis. And what it says is that when there are a lot of people, and they're all intelligent, and they're all computer literate, and they all have access to data, and they're all trying real hard because they're all highly motivated to get rich, that the combined efforts of all those people will tend to drive out bargains. It's kind of like I said about the gold rush. When there are a lot of people trying, and they're all well informed, and they're all comfortable with the risks and so forth, it's unlikely that enormous bargains will persist in that market. And so you have to reduce your expectations. And in an efficient market, and there are markets that are relatively efficient, like big U.S. common stocks, maybe you say, you know what, there, the probability of finding a bargain is low, and the cost of trying is high, so we're not going to try, and we're going to settle for average. There are other markets, and Ben talked about going into emphasizing those markets, which are less well prospected and less well understood, and these are called less efficient markets where it's more possible to find a bargain, and maybe you should put more of your efforts there. When I left school in '69, I ran into my investments professor off campus a year or so later, and I said to him, okay, well, tell me now, how would you run a big pool of money? And he gave me advice that stuck to this day. He said I would index the core and manage the hell out of the periphery. And I think that's pretty wise. In other words, the central foundation for your portfolio might be an indexed might be a mass of assets where your expectations for outperformance are modest. And you're not trying too hard, and you're not paying a lot of management fees, and you're not deviating too much from the conventional because you don't think that there's much of a payoff for deviating. And then you take a bit of money around the outside, and there you really go for it. And you knowingly take risk, you emphasize outperformance, you hire managers who you think are great, you give them a lot of financial incentives, and you hope that you pick the right ones. But I think that for a pool of money the size of CalPERS, I guess on reflection, I think that index the core and manage the hell out of the periphery is probably a pretty good piece of advice. So I'm glad you asked that question and triggered that memory.
So any other questions from board members? Okay, we'll see no further questions. We thank you. That's a nice applaud for Mr. Marks.
Thank you for having me in today. It's an honor to work with you.
Okay, we do have a request from the public to speak. And Janet Cox, a retiree. Where's the mic?
Thank you very much, Mr. Marks. I'm Janet Cox. I'm a CalPERS retiree. I'm wondering how climate-related financial risk fits into your structure.
Well,
Go to the mic. Go to the mic.
It's a very tough question. I thank you for it, but not easily answered. Obviously, the risk of continued negative climate change is a risk we all live with. Unfortunately, there's a category of things that I call improbable disasters. And unfortunately, climate change may not be that improbable. But, you know, these are things where they will have negative consequences, importantly negative consequences for us, but we don't know what to do about them. I guess the easiest thing to say is that we hope that companies and countries that injure the environment will be stopped from doing so, may be penalized for having done so, and so investing in those companies and countries will be penalized and turn out not to be wise. And I think that now it's easy to say that about somebody who clearly damages the environment, but there's a scale from 0 to 100 in between, and some of the cases are not easy. But I think the main answer is that the treatment of the environment is one of the important things that should be considered with regard to every investment. And, you know, you probably wouldn't want to make investments where you say, well, they're beating up the environment, but we think they'll make a lot of money, so that'll be great payoff, because in the world that I hope for, we will not, there will be costs and penalties associated with damage to the environment. But, you know, it's not easy. Thank you. Oh.
Mr. Perez.
So, having that in mind, for the specifics of this fund, excuse me, how would that affect the way you would handle that for us who our mission is fairly clear, and it's only to make sure that the fund is there for the beneficiaries?
Well, the easy answer, Jason, is to say that we should look at the costs that will be imposed on a company for damaging the environment like we would any other cost or risk. And that's what a so-called economic person would do. You would consider that among the investment factors that you take into consideration. The question is, do you want to go beyond that? And that is not exclusively an economic question. Do you want to say, we will not invest in any company that damages the environment? And you can say that if you want. Sometime it'll cost you money, especially in the short run, to have that as your rule. And that is probably a guideline that should be imposed on the investment office from outside, if the board wants that to be the case. Not, since it's not an economic rule, it shouldn't be imposed from the inside. I think that the investment office should have the job of achieving the 7% goal with the least risk and with the best ratio of return to risk. If you want to go beyond that to include non-economic, non-immediate economic considerations, I think that would be the job that has to come from outside. But you must realize that, you know, for example, if you look at, I think it's fair to say that if you look at the 1970 to 2000 period, there was only one company in the Dow that achieved 15% return every decade, and it was Philip Morris. So, you know, if you're going to say we're not going to invest in tobacco stocks, you have to realize that may cost you money for significant periods of time. That doesn't mean you shouldn't consider it, but that would be an added complication to the work of the investment office. It's easy to ask them to take the costs of environmental damage into consideration. It's hard to ask them to put on a prohibition which is not related to risk and return. And by the way, it's one of the hardest questions to answer today.
Okay, thank you very much.
Okay.
Okay, I did make an exception on this particular question from the audience, but going forward, we will not have a back and forth between the audience and the presenters, because everyone would, start lining up, and we really have some time certain issues on the agenda. And that brings me to the next time certain is we can't start until 11:15 because he's going to be Skyped in. But at this time, I'd like to ask Karen to announce a few housekeeping items.
Sure, thank you, Henry. We're actually going to take a quick break, and we are going to come back right at 11:15 for our next discussion about the regulatory landscape. So thank you.
Okay.